All right, we're off and running here. As you come in and enter the webinar, let us know what market you are in. Let us know the activity that you're seeing since January 1st. What market are you from? And what does the activity look like? I'm Byron Lazine, and I'm going to announce our two guests here in just a second. This is a BAM and Formations webinar, how to set up investment strategies for retirement. As you enter the webinar, let us know in the chat, what market are you from? And what have you seen since January 1st here in the new year in your market in terms of activity? Fill that chat up. As you come across a question that you would like answered, put that into the Q&A block. Let's try to keep the questions in the Q&A separate from the chat room. Okay, so chat's going to be any conversing, and obviously, razzing Eric, whatever you want to do in the chats, go ahead and do that. And then put all the questions in the Q&A. That way we can keep it separated. We will go to Q&A at the end. So welcome to this webinar we're doing with Formations, how to set up investment strategies for retirement. I'm Byron Lazine. Oftentimes we don't think about this as agents. We're chasing that next deal. That's why we asked the Formations founder, Shahar Pleener, to come in and break it all down for us, along with Formations head of fulfillment, Brian Weir. These guys are going to break it all down. I've got a number of questions for them. We're going to go to Q&A at the end. Let's jump right into it, fellas. How are you guys doing today? Good?
Yeah, doing great. Happy New Year. I think technically you're allowed to Happy New Year people 4 weeks. I think
no, too late. No, it's too late.
I think technically it's 4 weeks through. So Happy New Year. Everybody.
You'll have to show me that. I think it was 2 days, not 4. But anyways, Happy New Year, fellas. All right. Listen, this is a problem. This is something that people ignore often, where it's like, I need that next commission check. Certainly in a market like this, it is all about, making sure you're going to be able to do enough deals. And everybody knows that agent in their office that's, 70 years old. And it's like, man, is she hanging on because she has to, or is it because she hasn't figured out a way to retire, right? There's not a 401k set up for her. You're an independent contractor. So all these different, parts of being a real estate professional kind of factor into this. But let's just start with the basics. What are some non-negotiables for real estate agents when planning for retirement? Whoever wants to start, go ahead.
So Byron, I think we had a discussion, a couple of weeks ago about discipline, setting goals, and making sure that you as a real estate agent takes care of you first. We speak about this profit first concept. I think this is the fundamental. I'm sharing a story about Sophie. Sophie was one of my early customers, I don't know, about 15 years ago. She's a real estate agent, here in Seattle. She's average, actually she's below average. She's making about $70,000, $80,000 commission every year. But for 25 years, she was really, really, really consistent about her retirement planning. And kidding me or not, she's sitting on a $50 million portfolio of real estate today here in Seattle. So again, she was lucky because she was in the right place in the right moment for the last 25 years, observing the growth of the Northwest. But don't tell me stories that you're not making enough. This lady, again, just by being disciplined and taking care of retirement first, built an empire of real estate, literally or not. She's sitting on $50 million of real estate here in Seattle. And you know the drill, you know how to make it, you guys know how to make it really efficient. But I think this is the fundamental. The fundamental, if you want to make it, it will happen.
Brian, your thoughts open up.
Yeah, I completely agree. To build on that, I think diversification is non-negotiable. You should have your rental properties, you should have your regular stock portfolio, and you should have an aggressive retirement planning that's in a retirement plan. Tax savings as well as growth are really important structures of retirement. And it's easy to put your eggs in the basket that meaning buy all real estate because it's going to grow, but don't ignore the other opportunities that are out there, as well as do some every quarter or every month. Don't wait till the end of the year before you file your tax return. Really get engaged in your retirement planning and figure out, from each sale, I'm going to put this much away, or each month I want to put X away, so that you're not looking at a $40,000 check in March before you file your tax return and you're not sure about cash flow. build it into your plan.
I think that Byron, one thing that we're continuously telling people, use experts. This is not negotiable. Like, we cannot do it all by ourselves. You can be dangerous enough, to influence some of the decisions, but God, there's like such an amazing network around us with mortgage people and real estate people and investment people and retirement people. Hey, get an advice, bring the best people around you to make sure that you collect, those cluster of thoughts, and then make the best decision, for you. But again, the non-negotiable part, don't do it alone. Don't do it just by yourself.
Yeah, and don't rely on H&R Block to do it for you. That's for sure, right? That would be a big mistake. They're not going to help you with that kind of stuff, and that's also not where you want to be doing taxes. You definitely don't want to be doing your retirement there for sure. So first off, we got somebody asking if it's going to be recorded. It'll be recorded. So if you got to bounce out of here, you're going to get an email with this full recording. You'll also get a link, and we'll put it into the chat here. If at any point you want to schedule, Formation's offer to you is they're going to give you an opportunity to schedule. If you've got a really personal question, if you've got something particular to you, if you want to explore setting up your retirement strategies for your future, they're going to give you a link here so you can go ahead and schedule that call. So listen, you said diversification. You said use an expert. Yeah, totally agree. Now, diversify is often almost overused, right? Because it's like, well, does that mean I should have a little bit of Bitcoin, a little bit of ETH? Does it mean I should be buying my own stocks? Should it be 401k? Should it be self-directed 401k? Or should I know real estate? I'm an expert in real estate. Should I just buy more homes because I know, what a good deal is in my market and what's not a good deal? When we say diversify, like how much is too much diversification?
I think diversification is level of comfort. I think that you don't need to go across 20 different, investment strategy to fulfill the word diversification. If you're a real estate agent and you feel comfortable around investing your money in real estate, diversify between, long-term strategies and short-term strategies. Make sure that some of your tenants are maybe an Airbnb style, and you have the short-term kind of more of the money, immediate to get the cash flow and fulfill some of that FOMO and desire, but also buy some real estate that will park there for the next 5, 10, 15 years and appreciate in value. So just diversify between cash flow and long-term holding. Same you can do, just getting out of real estate. You can get out of real estate into the stock market. And in the stock market, you can diversify between plans that are what we call pre-tax, the 401k of the world, the SEP IRA of the world, the defined benefit, the cash balance, or basically, which are a little bit more conservative. Those returns on investment are not penny stocks, are not, the ones that are super risky. This is a long-term gain, and I want to make sure that my money is protected versus, putting some money on some short-term investment that can be, again, a portfolio of stock that I am the one that pick and choose. So diversification is more, I think, for me, a language of comfort, but what I'm telling agent is by nature, you can or must continue to increase your comfort zone. And when we increase the comfort zone, we're getting into the learning zone. And the learning zone is really amazing because if you go too far on your amazing zone, you'll get panic. So make sure that you get comfortable again. But keep in mind that as you continue to learn subject, your comfort zone will start moving with you, So get into, be curious. I don't say that you need to, by default go on all of these buzzwords and trends and do crypto or I don't know, investing in some crazy, shit that is more trendy. Cover the basics. Cover the basic means, and we can walk through, some of the more basic stuff, but it just means that you need to get into a more of the curiosity and make sure that you, again, involve people. Don't do it yourself.
Yeah, I would argue that every real estate professional should be buying more real estate. That investment vehicle better than any other vehicle, right? Oftentimes you're just passing up the best deals for 2.5 on the commission. You're passing these up for 3% of the commission. Why not get on the 97%, the 97.5% of the deal? Why not get on the equity in that property and hold it there? I mean, listen, I want you guys to get into some of the tax strategies on holding a property long-term and renting it out. But I don't know why agents aren't doing more of just that, buying up property. I mean, this is the Dave Ramsey formula, right? I know he doesn't put debt on property, but he just buys up house after house after unit, and he builds a huge portfolio because he knows it. He was brought up in real estate and he wants to buy more of it because he understands it. Brian, when we talk about diversification, should an agent just start with just what I said, buying homes, or what would you do? Do you start? I know up to, a certain amount of money you make, you can put 6,000 into, an IRA. What is it? An IRA?
Yeah, you got it.
I think it's after 175,000, you kind of get, somewhere in there, you get stopped from being able to do that. Should they start with that? If you're making under a certain amount, where do you start?
Yeah, I mean, it's a lot of it's about cash flow and how much do you have each year to put that into a plan or other investment vehicle. I think that, we talk about your first property being a small condo that you can pay off relatively quickly and then have a lot of equity in it to leverage if you want to later. So that's always a great thing, spending $200,000 on a condo somewhere in a market that paying it off for 15 years or less, if that makes sense, or longer, depending on what you're looking at, is a great first step because that market, what's going on there. But once you have that really secured and you've got positive cash flow for the property and you're like, all right, so that's taking care of itself at this point, which is really what happens with most rental properties, especially if they're Airbnb style, which is a little bit more time consuming, but more profitable. Then it's how much money do I have to put away? If it's only under 6,000, a standard IRA is perfect. That's an easy way to get it. If you start to make too much money, you can do other things around IRA still, like backdoor or Roths and various things. There's things that can be done out there. But once you start to get past like wanting to put more than 6,000 away, you should go into more advanced strategies. 6,000 in retirement each year is not that much money into retirement, especially if you're in a solid 6-figure net income, you're in the 200,000 or 300,000 a year. 6,000 is a drop in the bucket. So you really want to start to level up what kind of plans you're using. Are you doing a solo 401k with employee and employer contributions, allowing you to do like $61,000 to $67,000 a year? What is your strategy to start to build when you have additional cash flow? But I think that everyone in the real estate market can benefit from a rental property because you know it so well. And it's such an awesome way to just get cash flow neutral or positive in a property quickly, and then start to layer on additional pieces because automatically over 20 years, that's going to grow tremendously. So like Shahar said, bright, shiny things like crypto and other things out there, go with your comfort level, get involved with some of them, but don't put in anything that's bright and shiny, don't put all your eggs in that basket. That's a really dangerous thing. Standard investments are good, stocks and everything like that, but work with a professional and make sure that take it a little piece at a time. What start there, and then move on to things that you need to learn about, like Shahar mentioned, and then start building these large investment portfolios. Shahar and I kind of sit in different places with Roth for high earners, so talk with a financial advisor about that and decide what's right for you. But having a blended pre and post tax accounts, whether it's a Roth or other financial mechanisms like life insurances that can build over time in a post tax environment, you want to make sure that you can pull some money that's pre-tax and some money that you don't have to pay any taxes on. So there's a lot out there. It's super confusing. Definitely start with little bits of and then grow over the next 10 or 20 years in your knowledge base.
Yeah, the first webinar that we did, Shahar, we talked about all the different bank accounts when we were talking about getting prepared for tax season. What is your bank account strategy? And having one of those accounts automatically feeding savings, which could automatically feed one of these investment vehicles every single month. So you're not trying to make it all up at once before tax season. You're not trying to do some type, get a whole bunch of money together because you found a big deal. You're doing it every single month as a natural discipline within your business. And I agree, work with the experts so you can focus in on building the business as big as you possibly can, building that business cash flow to be able to go and diversify it around. Is let's go into minimizing taxes specifically for retirement. Okay, so how do I, like, if I'm gonna, maybe I'm at the point where I'm gonna retire in 10 years or 15 years or 20 years. How do I start to minimize that tax burden? Is it through owning a bunch of real estate and putting debt on it? Is there another strategy? What would be your advice to minimize taxes for retirement?
Byron, that you mentioned that sometimes real estate agents are slow to respond to some of the real estate opportunities around them. Some of it is related to the fact that they don't have their financials in order. And if you don't have your financials in order, you don't have like a P&L or balance sheet or just a pay stub or something to show, super fast into the underwriter, again, it's hard to get into those deals. So when Brian is speaking about cash flow and when Brian kind of mentioning, that there's lots of options, it all starts with, you need to understand your business as a business owner. You understand how much money you make. You need to understand that, putting your financials in order, it's a strength. Doing bookkeeping or making sure that you have, a financial statement, something to present to a banker, any day. So you can act fast, all those opportunities. This is why your customers are bidding you on opportunities, because they're W-2 employees, and to underwrite them, it's pretty fast. Make sure that you have all of these in order so you can have a package actually ready to present to an underwriter so you can act fast, because you cannot buy those properties cash. You'll have to take, some debt. Now,
Listen, so some of the, sorry, Shahar.
Yep.
Some of the things Shahar just mentioned: financial statements, your P&L for your business, your bookkeeping, your tax strategy on your business. Okay, are you paying too much in taxes? Is your business set up the right way? LLC, S corp. By the way, these are the things that Formations does. They partner with you to solve those issues. So that we've got an offer for you in the link below to set up a conversation, because if you're sitting there saying, yeah, I want to go push some money into retirement, and to Shahar's point, you're going to go try to borrow money to go make that investment, and these things aren't tight, those got to be tight. They got to be right first. Go have that conversation with Formations. What else to add to that?
So then when you want to act fast, and assuming that you know how much disposable income you have, I think that the stock market or some retirement plan that tied to the stock market. And again, I'm not telling you in what to invest. You can go all aggressive on, tech stock. You can do also money market to just keep the money in your 401k into kind of a saving account or in a bond account or in something, treasury that will give you today 4, 5, 6% guarantee. The beauty is that those retirement accounts are bank account. The second that you just set those accounts, it's basically the speed of the wire transfer. And if someone basically wants to save $20,000 in taxes at the end of the year, and he's basically, in a 30% tax bracket, all what he needs to do is just fund, a $60,000 401k or SEP IRA. The beauty about it is that you get the tax savings. Again, I'm moving $60,000 into my retirement account. I'm getting a write-off immediately of 25%. If I'm in a 25% tax bracket on $60,000, instead of just parking it in my checking or saving account, moving it into my other new bank account, retirement account, I can get basically the two things. One, I can get the immediate tax savings. Again, 25% on $60,000, do the math. Again, it's like an $18,000, $20,000 of tax savings. Immediately, boom, tax bill reduced. Second, the money stays with you. What we see people basically panicking on tax bills, they try to find expenses. They try to find deductions instead of find, what we call, a profit first buckets. How can I fund something and the money would stay on my pocket? And third, you can choose and pick with your financial advisor, with the person that helped you to make those financial decisions, where to invest the money. So you get the tax savings, immediately. Yeah, you get the write-off. You get basically the opportunity to keep the money with you and let the money continue to grow. So I just want to make sure that people have, in their mindset, the difference between saving and investments. Savings usually doesn't yield. It's a short-term something when I want to park my money. Investment is something that I build for the long term. And in the near future, to the mid future, to the long-term future, will start paying me back, out of that money without me need to do anything for that. So I think this differentiation is super important, and the ability, to act fast, on investment in the stock market is critical. And as Brian mentioned, I would start it today. Why to lose basically all of the market appreciation? Byron, I spoke to one of my financial advisor friends. He told me in the last 40 years, if you pick a day to put your money in the market, 75% of times, a year later, there's more money.
That's right.
This is not gambling. This is not going to Vegas and put money on black or white or whatever. This is what you call smart financial decision. Trust the system because the system is working great for you.
It's been working for decade after decade after decade. The thing about that is you can't take it out. I had an agent ask me the other day, it's like, hey, do you think I should buy this right now, then sell it and then get back in? I'm like, dude, I am not a day trader. I don't do that. When I buy a stock, I get into it. And I stay in the deal, right? Or if I send money to my financial advisor, which I do every single month, going back to those accounts that we talked about on preparing for taxes and how you have your bank accounts set up. I've got an account that just sends money to my financial advisor every single month. Now I can increase that amount or I can decrease that amount, but there is flow going over there every single month. Right now, it's just been very consistent. When COVID hit, I'll tell you in March of 2020, I was like, bro, I think we're going to throttle this down for about 3 months and just see what happens here over the next 90 days. But there's always money going in and we're being very conservative there, but we're not selling. We're not pulling out, right? Here's the thing. Here's another big risk agents make as well. So a big risk is not doing this kind of stuff, not being set up like a business, the stuff that you guys help people do, and having money flowing into investments every single month. That's just a risk for, your ability to actually retire someday. But what if something happens? I'm amazed how many agents are just rolling right now without proper healthcare, without a plan if something were to happen for their long-term care needs. So how can agents plan for that, for a long-term care situation? How does that fit into the financial strategy picture? Brian, I don't know if you want to jump in there.
Yeah, I apologize. I had to go grab some water. All of a sudden started coughing a bit, so I apologize if I jump off. I'm sure Shahar will jump in. Long-term care shouldn't be on your mind only when you're hitting 60 years old and you're thinking about what are my kids going to need to do for me, what's going on. The sooner you get involved in any long-term care planning, whether you're 20 or 30 or 40, the better it will be and the cheaper the options are out there to you. You definitely want to work with advisors on this. It's complex and you want to make sure you're getting the right plan. But my personal opinion, I think Shahar shares this, is don't try to go out there and get life insurance separate from long-term care, separate from all these different mechanisms. Work with someone who's really familiar with the idea of long-term care and life insurance, because there's really cool plans that allow you to have 3 different parts to it: an investment part that doesn't lose value, a long-term care benefit part. So if you do have an emergency that happens early in your life or even later, as well as life insurance policy for your heirs or your spouses. So those plans, you can get all of them in one plan, which means instead of paying 3 different providers and working on all this stuff, the sooner you get in when you're younger, the cheaper the life insurance is, which is actually the driving underneath policy. And the remainder of it is this really tax beneficial strategy, protects against market influences, and also can have these LTC underwriters on them that give you benefit, and you decide what's right for you and how to turn it up and turn it down, which is really nice. But those plans are spectacular. We have one in my household and it's yielded great results over the last 10 years. It's starting to slow down right now, but the nice thing is they don't lose value ever, which is fantastic.
That's a set it and forget it, something you're going to be into. You're not looking to get out of it in a year. These are not vehicles where you're day trading. It's you're making the investment for the long term.
Almost all things. Oh, go ahead.
By the way, it's a bit scary topic, because when you think about long-term plan, and you ask people kind of to describe the services, it's assisted living facilities, adult care or adult daycare. nursing home. It's those terms, when you start, just talking about it, it feels like, some old guy with the diapers, and it's not me, I'm the workforce, and kind of, how that related. But those plans are cheaper when you are healthier and don't need to use them. So to buy into, again, long-term care or life insurance policies or things that basically will give you the benefit in 20, 30, 40 years from now, it's always great kind of, to engage when you're healthy, and there's no need for that. Once you need for that and you get a little bit older and some chronic diseases or some conditions are raised, those plans can be very expensive. I think the first part is just to have the conversation. First, to have the awareness, that those plans are there and existing. Second is to understand what my lifestyle will be, in 20, 30, 40 years. And this is also a discussion that it's not, I'm not trying to bring to my kids. Again, my kids are a little bit younger, so it's more a decision between my wife and I. But once the kids are growing, become kind of in their 20s, bring the kids into the discussion and kind of describe, what do you feel will be kind of the lifestyle, or how do I want my parents or my grandparents kind of to live at the third age of life? Start having those discussions today. There are great solutions, and Brian mentioned the life insurance, for instance, policy can serve as, your bank. You build your own cash equivalent or your own cash policies into those plans, and then it takes a little bit, 10, 12 years to build some significant cash, but then it becomes your bank. You can borrow against it and pay yourself an interest. So I think there are great instruments out there for people just to get to know and get familiar with.
In the chat, if you're an agent that has seen this situation before, maybe drop it into the chat, where you go on a listing appointment and you're to Shahar's point, you meet a homeowner who's in that third stage of life. And unfortunately, your heart breaks when you meet them, because you realize very quickly that they need every single penny out of that home to be able to even get into care facility, or to even to be able to live the last chapter of their life. It's all bottled up in that one personal home. I think we can all agree a personal residence is not the best investment strategy. Agents, we know this better than anybody, right? That personal home, oftentimes when you have to sell it, might not be the time to sell it, and certainly isn't a great investment strategy. And so don't put yourself in that position as somebody who's a 1099 contractor, as somebody who's, just trying to build a business. Take the time to slow down right now, whether that's cutting out unnecessary expenses or just being disciplined and putting money into some of these retirement strategies right now every single month, so that when you get to that point, you're not that homeowner that we've all met numerous of times on these listing appointments. So how about protecting retirement savings, building a nest egg, or just consistent retirement savings? How do we protect against a market crash, right? There's a lot of fear, or this year, there could be some type of complete meltdown. There's a lot of people that think we'll have a nice little soft landing here, but let's just go worst case scenario. How do we protect from a major financial crash?
I think we mentioned it a couple of times. First, don't panic. I think that we're playing a long-term game. And I remember people basically in March and April of 2020, when just the pandemic hit, everybody was kind of very reluctant, or the other side was very kind of, enthusiastic, basically to pull the money out of the market, because again, the doomsday is arrived. And we all know that, from the down kind of March, April of 2020, we got into the peak of 2021, and the market basically appreciate, gazillion amount of percent. So it's very hard, I think, to time the market. Therefore, again, for our investment advice, which is all about kind of tax savings and how to make your own kind of smart decision, it's all about don't panicking and just let basically, the system correct, and make sure that, again, that your eyes open. Again, you're not ignoring it, but again, I think we survived the 2001, the 2008, the 2020. Now, again, it will take some time. But again, when you make smart financial decision and not panic, and someone else is panicking, this is your opportunity, because now there is opportunity to buy stuff either cheaper or at the discount. I think Brian mentioned again some of the life insurance policies or the life insurance product. December of 2019, the Secure Act was passed. Again, it's a long name. It's the Setting Every Community Up for Retirement Enhancement Act. You know, and this is kind of where the government is putting way more fun stuff into the retirement fundamentals that will protect and secure the investors. One of them is things that are related to fixed rate investment or life insurance that will give you a protected rate without the downside. I made a decision, for instance, for every kid. I have 3 kids. Every kid that got born, we're building basically a universal life insurance. It's not for the debt protection. It's more about the fact that you build this cash equivalent, and we put $5,000 every year. Time flies fast. You know, my oldest just turned 13. Multiply 13 years by $5,000 and the appreciation. The dude has $150,000, you know, available for him. And this is, you know, before it continue kind of, you know, to be funded all the way to college and beyond. So just one example.
I have a whole life insurance plan on both of my children. People are like, well, that's a little morbid, but to your point, it has nothing to do with any death benefit. It has everything to do with having a chunk of guaranteed cash at the time they turn 18, which is when they're going to make a decision on whether they want to go to college or not. Right. And I don't want to have not thought about that discussion. Right. I want to be in a position where we can actually have a chunk of cash to make an educated decision, whether that's the right move or not. But putting it into that vehicle allows flexibility to decide, you know, what to do with that cash. All right. So I see some questions rolling in. We're going to go to the Q&A. Go over to the Q&A box if you could. I see a question in the chat and I see one in the Q&A. We'll start diving into these questions. We'll start with Chris, who had a question in the chat. What would you say should be a standard rule of thumb for how much to allocate from a $10,000 commission check into a retirement savings account? I've got my answer. I guess we'll start with Brian. We'll go to Shahar, and then I can give my answer. And $10,000. What's your rule of thumb for how much you go into retirement savings?
Absolutely. You keep hearing about cash flow and cash flow and cash flow. What this means for you is always make sure and pay yourself first. Cover your bills, cover what you need from that commission check before you move on to retirement. Think about taxes, because they will come and get you if you haven't been planning for them. So depending on the state and your tax level, you should kind of earmark some of that. But a general standard rule of thumb is 10% of your income should go to retirement. Now, if you haven't been doing a lot of retirement and you're getting older, you should turn that up a lot if you can. If you've got a huge amount of retirement from some prior work and you're like, hey, I want to do some more rental property things, you could lower it. But at bare minimum, I would try to do 10% of my net commissions into retirement without any question until I at least hit the maximum for the year. And then I would diversify what I'm buying.
I would add to that as an employee of your organization, 10%, it's a great rule of thumb. What is amazing about the tax system, that the tax system allows you to do an employer match. You know, so again, this is why we're thriving under the S Corporation, because the S Corporation allows you to be this W-2 employee and put the minimum $10,000, $15,000 a year into a 401k, wait until the year ends. By the way, I already know my financials in the middle of the year. I know my financials, you know, at the end of the year, because I'm tracking, I'm inside my financials, and I know that my business can actually match, you know, 25% profit sharing. And now sometimes, you know, this 25% can be almost like double, you know, the fund. So I put about $15,000 or 10%, 15% of my my employee hat as we go, and then I plan to double it, you know, with employer contribution. And now I have a significant, you know, $15,000, $20,000, $30,000 every year, you know, in no time, 2-3 years, you know, $100,000 converting into a self-directed IRA, and boom, I have a down payment, you know, for 2-3 properties. So again, it's the idea of what Byron mentioned at the beginning is the consistency. It's just the commitment. It's the SLA, the service level agreement between me and my business, that no matter what, retirement comes first. And maybe this month I will buy less on my clothing, or take my customer to less of these golfing, or do if I'm struggle. Although again, we're also talking about debt and how debt, smart debt, can actually fill out sometimes the gap of cash flow. But I will never give up on my profit first, my retirement funding on a monthly basis.
Absolutely. If I don't know if I can do this. Oh, it's not going to work for me, huh? Oh, wait, here it will. It will. I'm going to break down something here for you, Chris. And there we go. Okay. All right. So we talked about this on the last webinar. Number one, you want all your commission checks going into your business account. Okay. Is that backwards for you guys? You guys
No,
reading that
perfect.
backwards?
Perfect.
Coming in perfect. All right, good.
Yeah.
So this is where all your commission checks are going to come into. So your $10,000 check, that's going into your business account. That's where you're going to have your broker drop in the money, not your personal checking account. Your personal checking is going to be over here. Okay. I always call it the household, but this is basically your personal checking account. Okay. And then over here, you're going to have a third account, a savings account. I call it tax savings because Shahar and Brian know better than anybody, and they can walk you guys through this stuff. This is what they do for people. If you're not set up to pay your monthly or your quarterly taxes in this business, you're making a huge mistake. So you've got to have money going into here on every single check. I don't know what you're going to call that. They're going to have a lower number. I like to go high, 35% into this count, and you can pay yourself a dividend at the end of the year when you have tax saving strategies like Formations implements, and you're only paying maybe 25% or maybe 20% of your money going into taxes, right? Everybody's situation is going to be different. So I'm taking 3,500 of this 10,000 and I'm going over here into tax savings. I'm going to keep building that. So I got no problem with my taxes. Now, everybody knows their number is going to be different than somebody else's. What do they need to maintain their household with every single month? You got to know that number, but let's call this another 35 to 40%, probably, 35% at least. So another 3,500 of each check is going into your household. Now your business, right? You're left with $3,000 over here. Okay. This shows you got to make a lot of money, right? As a 1099 professional, you got to jack up the deals, my friend, because if you're putting 35% of the household every single deal, now this can start building up and you can add other accounts like, oh, boom, I'm going to have that retirement savings account down here. And I'm going to start taking 30% of this every single month to go into my retirement savings. But you don't get there unless you're paying your household first, your normal bills, like Brian said, paying off your taxes, maintaining your business so you have the next $10,000 check, and then boom, out of my household, I'm going to start taking 30% of that, 20% of that account and open that fourth account, that retirement savings account. That's how I've thought about it. That's how it's kept me very consistent by doing that each and every single month. So I've got money coming in. We've got another question from Alethea Martin. What advice would you give to someone as to how to invest and or buy investment property through your LLC with little money? Ooh, dream scenario. All right. So buying investment property through your LLC, Shahar or Brian, jump in and help me out here. What do we do?
So first, we want to make sure that you buy the property not under the LLC that you run your business. Like, we don't want the business to own assets. Like the commission business, your consulting business, your real estate business, the business that you collect commission and talking to customers should be net of assets that instead, in case of something go wrong, there's nothing to go after. So the assets that you hold for the family, always we own it on a separate, and it can be a single member LLC, because then you don't need to file a separate tax return. It just go directly on your Schedule E. Now, the beauty about real estate is that if you have your financials in order, if you're up to speed with your financials and you can, present a set of financial to a banker, there are great programs today on mortgages that will allow you to take, as 95% of the cost of the money, of the cost of the property, and put as little as 5 down. So the idea is, if you have a great set of books and you have a steady income and you can show, kind of how organized you are, depending on smart debt will get you as fast as possible into those properties. So usually, again, buy the property under your name, so you don't need to deal with all of this quit claim deed and moving the property from the LLC for the mortgage or whatever. So buy the property under your name, put as minimum down payment as possible. Make sure that you put tenants, inside and charge a market rate. And if everything goes well, usually if you charge market rate for the rent should cover, at least, significant amount, if not all, of your mortgage payments. So now there is just the idea of just maintaining it, in a really kind of consistent way. Usually we're betting on the market just to appreciate. When the market appreciates, you gain a little bit more equity inside. You can refinance, you can take some more money, or you can actually build more stable debt to equity ratio. But I think the manifestation here is the manifestation of do. You guys are doing it all day long. It's super easy for you to buy properties for other people. Next time that you see a great opportunity, just think about, sit and reimagine what happened if I could buy this property for myself, and just do it.
You're absolutely right. If you have an LLC for your business, do not buy real estate in that LLC. It's 100% correct. Even if you're going to go buy an office for your team or for your company to support go buy that personally and lease it out to your company, right? You do not want to go buying real estate up in your personal your business LLC. Rather, you may decide to put LLCs on these different properties, different ball game, and totally different conversation.
By the way, Byron, the buying office for your own, it's such a great tax saving mechanism, because on the real estate piece, you get the depreciation. You get basically the book depreciation, which is not in your pocket, which means your business can pay above market rate. To cover all of these expenses. So let's say first I built my expense schedule for my real estate, and I have, my mortgage and my property taxes and my maintenance and my utilities and my HOA or my whatever, fees that I need to pay, plus, the depreciation. Depreciation can be huge. I'm buying a $2 million, investment property. Depreciation can be, $50,000 a year. And now I can basically charge my business for those rental expenses, where I deduct it in full from my business. So it's 100% write-off as a business expense. And on the other side, I don't pick it up as an income because I have enough deduction to offset. So this is like an unbelievable way, to gain also the retirement plan, because now I'm sitting on a $2 million commercial space that will continue to appreciate. And one day, I'll retire, move away. It can be a rental property, or it can be an exchange, or it can be, everything else in the playbook that about how to get rid of a property in a very tax efficient way.
What Shahar just described is the most basic tax cheat code available to real estate entrepreneurs right now. We got another question in about 529s. Brian, before I jump into that, did you have anything to add to that?
No, just echoing everything everyone said. If it wasn't clear, don't put in a rental property or property in your service business LLC. Open a new one, keep it disregarded, or just don't have one. There's a lot of good liability protection, but those are substantially different activities, even though they're still both in the real estate sphere. If you think of it that way, you really just don't want to cross-contaminate your books that way. It's messy and it's not necessary. If you want to build an investment portfolio through an LLC with properties, that is an achievable thing, but it's really separated from that commission-based income.
And the second part of this question Aletha had was, how do you do it with little money? I don't know. If you figure out a hack for that, let me know. I would say, if you have one of those 3.5% loans available to you, obviously, that's an opportunity, but you're not going to be able to do that in an LLC. That's going to be a personal purchase on a 3.5% loan, more likely than not. or you can get a seller to finance the deal for you. Maybe they're, you know, just fed up with the property. Maybe they're at that third stage in life. They don't want to manage the deal anymore. They've been self-managing it for 40 years. And, you know, maybe it's a high turnover rental property and you can take it off their hands, do the grunt work and do a 3-year, you know, seller finance. You know, that's an opportunity for little money, and not a lot of ways to buy real estate with little money. We all know that. Erica asks, I'd like to hear what you guys think about college 529 accounts. I've been watching one I set up lose money in the last year. Should I just keep that money in a high interest account or keep funding the 529 accounts annually? I know when I looked at 529, I liked other vehicles like the whole life insurance that we talked about earlier better, but what do you guys think about 529 accounts? What's your thoughts on those?
So I'll tell you personally, I'm not doing 529s just because one, I'm not sure where my kids will study. You know, we are this is an international generation. You know, they're traveling, they can work from everywhere, anywhere. And for me, 529, it's a very old-fashioned 90/80. And if I need, call it, you know, $500,000 for each kid for their college, I buy a rental property today. I buy a $250,000 rental property. I put a $20,000, 20% down. You know, I put $50,000, you know, as an investment into the building, and basically let it run for the next 27 and a half years, 15 years, 18 years. Have the tenants basically clean the mortgage and look kind of what the magic will be. Like in 15 years, when my kids will be in college age or a little bit less, I can refinance, take the equity out and pay for whatever they want. I can buy them car, I can pay for college. I'm very flexible, you know, and the beauty about it that as we go, this is a tax write-off. In most states, the 529s, Brian, correct me if I'm wrong, but there is no federal deduction for 529, which means it's an after-tax money, the growth would be tax-free. And in most states, there's also no much of a deduction over there. So it's not a tax, you know, it's not a huge tax savings mechanism.
Yeah, it depends on your state. You know, I do have some support for 529s. In my opinion, 529s are great for grandparents, for nieces and nephews, for cousins that want to send money annually to kids for their college and things of that nature. So if you've got one set up, keep it. It brings a lot back the conversation about these are all long-term plans. So I manage quite a few 529s for my nephews and nieces, which there's a lot of them. I send them money for their birthday and for Christmas and things like that, just to be participating in their education. And I do get a tax break here in my state of Oregon for it, for 10%. So I'm saving some money on it, which is nice. But it's not about what happened in 2022 to your 529. It's about what happened over the life of it and what happens over the life until that child is ready to go to school. So even though this is not about your own personal retirement, the long-term planning conversation is still the same conversation, that a year of transitional time where you lose value, and the 529s got hit hard because if you're the kids 20 years away from college or 15 years away from college, they're in highly aggressive portfolios, which means they tanked this last year and it was really painful to watch. But it still plays to long-term strategies. Just because you're scared when 1 year is concerning, it doesn't mean to stop doing it. Is a 529 the best or not? Again, I use it a very specific way for gifting more than anything else, because it's a great way to participate with family. You get a link, they can put money in it whenever they want. But overall, it's not one of the most advantageous tax strategies out there. If you have extra money laying around, it's a good way to build some tax-free income, and then put money away for schooling. But like Shahar said, you know, a $200,000 condo worth $500,000 in 15 years is a pretty safe bet for a college education fund.
Brian, do you want me maybe just to share just one sentence about why it's a great plan for grandparents?
So there is a lot of that can be done. So if grandparents are getting to the point where they're trying to get rid of money before they have to do any special taxes from their retirement program, or because they're going to pass away, you can do really cool things like $60,000 into a plan in 1 year, spread over a few years to avoid gift tax returns and estate tax. And so, you know, when I go out there and I'm going to hit the lottery one day, all of my nieces and nephews will get, which I don't play the lottery to be clear, but if I did, all of my nieces and nephews would automatically get $60,000 dropped into their account, because it's a little higher now. I could fund their educations. It has 10 years, and you could do large chunks and do this special planning where you're transferring a lot of money and avoiding any estate taxes, which is a long story because it's such a high volume. But there's some other cool stuff out there. And also it's just nice. Like you send a link, say, here, send some money for your birthday, and it just shows up and grows. So that's kind of how we use it in my family.
Wow, I love that. I did not know that about the 529. The ability to put $60,000 in 1 year and avoid that
By
tax
the way, they
liability.
changed the law, I think, a few years ago. Now it's also for K to 12. It's not just for higher education. I think they allow for private schooling,
Private
K to
schooling.
12 as well.
Yeah, but I mean,
just-
how much is it going to grow that fast, right? But that's the only
No,
thing.
the people that sit on 529s now
Yeah.
and don't know what to do with that and maybe need some liquidity, pay, K to 12 now and use the new money for kind of new investment opportunities.
Yeah, certainly, maybe by ninth grade, if you got an expensive high school, private school, that there might be an opportunity there. If you think, hey, maybe we're going to use this money now because maybe we're going to be starting a business at 18 as opposed to going to college, or maybe the kid, maybe you have a thriving business, the kid's going to come work for you, and it's going to be a better education than college in 20 years. Who the heck knows where that's heading, right? But that's a whole different discussion. Listen, I think that when I was able to start making clear decisions, and when I started with a great foundation, right? And that's one of the things that, if people want to have it set up the conversation with you, we've got that offer for them in that link below to go and set up a conversation with you guys about what's the right business for me as an agent, or whatever type, if you have a brokerage, whatever you have, is it an LLC? Is it an S Corp? What's the best setup there? How do I get these accounts set up to start having consistent monthly money flowing into the right place? How do I start saving money on taxes? When I have that really strong foundation built, now I can start making these investment strategies. I'm freed up to go buy the deal that I found instead of sending it to everybody in my database. I can go make the offer, getting on the 97% of the deal, the equity, instead of fighting for the 2.5 or 3% all the time. There's going to be so many deals in the market. You're not going to be able to buy them all. You're going to be able to service all your clients and all of that. But going out and buying the best deal that fits your needs, that fits your investment strategy, is a really good idea. When you have that foundation kind of locked in, you're in a much better place. Formations certainly can help you out with that. So we've got the link below. We're going to send you guys a follow-up email. If you came in late, you're going to be able to see this entire webinar in the email, and that link will be there available for you guys. Final thoughts, Shahar and Brian, and then we'll sign off.
I think you mentioned is the foundation. I think it would be a waste to use, the heavy guns to help you to do smart financial decisions and planning in the future if you just continue to bleed unnecessary, either expenses or taxes. Again, formations, we just, as we mentioned last time, we save on average $11,000 on taxes just by the move to an S corporation. And people that basically fulfill, some of our playbook about retirement, we keep in people's hands $18,000 every year in money that otherwise been just bleed into the system. Think about, in 5 years, this is a $90,000, $100,000 of so much more investment opportunity that you can actually make. And it's a will fly, because some of those investment opportunity for sure for real estate agents are a tax deduction. When you invest in real estate, the usual person cannot deduct the losses because they're passive against his ordinary income. Most real estate agents, because you're real estate professionals in the eyes of the IRS, you can actually deduct the losses, which means more investment in real estate, more losses. Again, most of the losses are on the books because of depreciation. More losses mean more tax deductions, mean more money in your pocket, which mean more money to invest, which mean more losses, which will, again, you understand kind of, So the fundamental is really, really, really big here. And again, 2023, I think that what we see early days, we're only 17 days, Happy New Year, 4 weeks, we still can say Happy New Year, but what we still see, we still people coming with some financial coma. We still some financial coma, end of the year, end of the year was people kind of invested strong in the business. They're maybe a little bit tired. It's time to wake up. It's time to wake up of this coma, search for the opportunity around you, and start make smart financial decision. Welcome to 2023. It will be an amazing year. from business and investment opportunity. So I think, the best.
I agree. And you guys truly do make taxes suck less. They're always going to suck, but you make them suck less. I love that motto that you guys go by. Brian, final thought from you.
Yeah, I think obviously everything Shahar said because he's awesome, but I think move from a reactive space to a proactive space. We talk a lot about make sure you're paying your tax out of this year's commissions, not next year's. Do your retirement contributions from the money you're making today, because you don't know what next year is going to look like. And the savings is real, the planning is real, and the growth is real. So don't move from a space of waiting for your shoebox and waiting for all this stuff for tax season to know where you're at, and do ongoing planning with a professional and work through these things so that you're really proactive and you're going in with a plan. If you need to deviate for the plan because market fluctuations, that's life. That's why you have a plan. But when you're just doing it on your own and you think you're going to make this much and you think you might pay this much taxes, it's really scary. So move to a place of being proactive and making decisions around your plans, both short-term and long-term, because when you have that short-term stuff figured out, the long-term planning and availability becomes a lot easier because you're not just still cleaning up from 6 months ago, 12 months ago. I mean, right now, January 1st of last year, if you're looking at your books from then, you're in a really bad spot because you're trying to work on it all. So really be proactive instead of reactive to it, in the same way that you are in all of your, market deals that you're selling houses. You want to be reactive to those and wait for a deal to come in. You're out finding those deals each day. Treat your taxes and your accounting the same way.
Yeah, if you're now having to clean up 12 months of 22 taxes, that is a burden that is going to hold you back. Don't let it hold you back. Hook up with these guys. Let's lock in. Let's have a great financial year in 2023. Shahar, happy New Year, brother.
Happy New Year, brother.
Thank you guys so much, Brian, Shahar. Really appreciate you guys. Thanks for dropping up so much value. And we'll see you guys on the next Formations webinar. Stay tuned. We got another one coming up for you guys very soon.
It's a pleasure.
Pleasure.